Hello and welcome to this session in which we will discuss the Unified Transfer Tax System. In the US, there's a system called the Unified Transfer Tax System that combines two types of taxes. Really, you want to think of it called the transfer tax. And what does this transfer tax include? It includes two types of taxes, a gift tax and an estate tax. What is a gift tax? What is an estate tax? Well, a gift tax, what's a gift? A gift when you give something to someone without expecting anything in return. So a gift tax, this applies when someone gives away property, money, cash, land, stocks, bonds, while they are still alive. It means you are living. Those are known as inter vivos transfer. It means while living. You give something to someone while you are living. This is called a gift. Now there's a gift tax. Who pays the tax? The person that's given, the generous person, will pay the tax. So the person that's giving the gift will pay the tax. Now, how much will they pay? We will discuss this. Also, we have something called estate tax. This happens when you transfer your asset, money, property, to someone, but that's after death. This tax is levied on the transfer of property when someone dies, referred to as testamentary transfer. It means you are giving something to someone, but not while living. If it's while living, it's called gift. After death, it's called the estate tax. So those are the two taxes that falls under something we call the transfer tax. Now those two taxes, gift tax and estate tax, they are really treated as one tax. And that's why we have something called unified. It means both are unified under one transfer tax system. And this is what we'll try to discuss in this session. What is this unified transfer tax system? Let's go ahead and get started. Before we proceed any further, I have a public announcement about my company, FarhatLectures.com. Farhat Accounting Lectures is a supplemental educational tool that's going to help you with your CPA exam preparation as well as your accounting courses. My CPA material is aligned with your CPA review course such as Becker, Roger, Wiley, Gleam, Miles. My accounting courses are aligned with your accounting courses broken down by chapter and topics. My resources consist of lectures, multiple choice questions, true-false questions, as well as exercises. Go ahead, start your free trial today. So the unique aspect of this unified transfer tax system is that it treats both. Both means what? Gift and estate tax, what? As a part of a single cumulative process for tax purposes. What does that mean? It means that both are considered together when determining the tax liability. So what's going to happen is this. You have to keep track of all your gifts. Then you have to keep track of all the value of the asset that you transfer after death. They are combined together when computing this tax liability. Sometimes you might have a tax liability before dying, and we'll see that. It might happen. So there's something called the unified credit or applicable credit. Simply put, what happened is this. You can give gifts up to a point. Up to a point means up to an amount. As long as you don't exceed that amount, we're going to see what that amount is, you're not subject to the gift or transfer tax. This is a credit that each individual can use against their transfer tax. So what is that amount? Well, as of 2023, and remember, every time I mention a year, it means this number could change. But as of 2023, to give you an idea, the credit available for the cumulative taxable transfer up to $12,920,000. In simple English, you can give away over your lifetime and after your death $12,920,000 worth of money, property, assets, and you are not subject to the tax. Why? Because you are allowed this amount up to this amount, tax-free. Once you gift or leave in your estate more than this amount, then that amount is subject to tax. Not bad, pretty generous, right? This means that an individual can transfer property either while alive or after death up to this amount without incurring transfer tax. So the transfer tax in the US looks at all property transferred to others both during life and after death and taxes it as one big sum with a significant exemption before any tax kicks in. And that amount, again, who knows, you might be very generous and contribute 20 million in 1 year, then you used up all your credit. Just to give you an idea about this credit changes from year to year. For example, 2021, it's 11,700,000. 2022, 12,060,000. 2023, 12,920,000. 2024, 2025, this number could change. It could go up or it could go down. It does not matter. The facts remain the same. The amount is excluded. Now, since year 2012, the tax rate for the taxes has not been changed. What does that mean? It means it's a progressive tax, and this is how it works. So if you contribute an amount above the limit, 10,000 above the limit, you'll pay 18%. If you contribute an amount above the limit between 10 and 20, it's 1,800, which is the 10% plus 20% over the amount over 10,000, just like your individual income tax. So notice if you are 1 million above the limit, so once you contribute, what's the limit? 12,920,000. Once you contribute above 13,920,000, any dollar above that amount, the government wants 40% out of it, almost half of it. Now this is only federal. Now in some states also that will kick in, so you might have to split your what's left after that between your family and the state, local state and the federal government. But this is how it works. Yes, so it is pretty high. Notice you could be in the 34, 36, 37, 39, 40%. It goes up very high. Let's take a look at an example just to put it into perspective. Now, you may or may not have to know this for the CPA exam, but working an example will just kind of say, you know what, that's good, now I know it. Let's assume Sam lives in New York. Sam made no prior gift in his lifetime, and he decides to make a $20 million gift to his friend Jordan in 2023. Excellent. What does it mean, 20 million? It means his contribution exceeds the limit immediately. Well, let's look. Amount of the gift, 20 million. First, there's an annual exclusion. Well, we didn't talk about this, but let's talk about this. Also, let's assume for any particular year you contributed $100,000. What's going to happen for, we're going to talk about this shortly, you can deduct $17,000. So if you contributed $100,000, what's going to happen is you contributed to someone, to one person, you gave them $100,000. What's going to happen for tax purposes, they would say for 2023, and this amount will change, you can deduct $17,000 from this, and what's left is $83,000. Therefore, when they tax you, they would say, count this toward your credit, because the first $17,000, simply put, you can give $17,000 to anyone without even it's involving the government. That $17,000 will change from year to year. So if he gave 20 million to Jordan, well, the government says, you know what? 17,000 out of this number is given, 17,000 is given, and it changes every year, is, we're going to ignore it. Therefore, what's left for you is 19,999,983. Are you going to be taxed on this? Well, not really, because guess what? You're going to have a credit of 12,920,000. So of the 19,999,983, the government says you have another exclusion. You can exclude 12,920,000. What's left for you is 79,983. Remember, above $1 million, you're subject to 40%. Therefore, you're going to have to pay taxes. Sam will have to pay 2,831,993 in taxes, which is 40% of the amount above 12,920. So this scenario only to show you how it works. So notice that the first 12,920 was excluded, and he was able to exclude 17,000. Now that 17,000 is per gift. So let's assume to all my subscribers on farhatlectures.com, if I decide to give each one of you 17,000, that's fine. I don't have to pay any gift tax. If I paid someone 18,000 rather than 17,000, I have one additional $1,000. Let's assume I gave everyone 18,000 for that matter. For each individual, an additional 1,000. I have to add up all these thousands and say, no, I'm going to have to count this toward my 12,920,000. So even though I don't have to pay taxes, but I'll have to keep track of my lifetime gifts until I exceed, and after my death, whatever is left for my family, it will adds up. And if it's more than 12,920,000, then I'll have to pay taxes. Let's go back to the taxable gift, because I talked about the gifts, and we're going to have a whole session about what constitutes a true gift, because there's a rule for that. So the concept of taxable gift refers to the transfer of money or property under specific condition. Again, when you give a gift, you're given a gift without getting anything in return, without receiving something or equal value. That's how we consider something a gift. Not receiving or receiving below value. The difference is a gift. And you're giving something of a tangible or intangible asset. They're both considered gift. Annual inflation adjusted exclusion. This is the 17,000. I kind of discussed it before, but that's fine. For 2023, as I just mentioned in the example, you can give anyone up to 17,000, and it's like water under the bridge. No one cares. The government does not want you to do anything. So you can give someone, you could just go on the street and start giving each one 17,000, and you don't have to file taxes for that. It doesn't count against you. Okay? Now, this exclusion does not apply of something called future interest gift, which we'll talk about that. This type of a gift that the recipient can only benefit at some future date, even if they gain immediately of ownership. Don't worry, we're going to have a whole session about what constitutes a gift. So hold on that. There is a special provision for married couple. If one spouse makes a gift, they can treat it as if half was given by each spouse. So this effectively double the annual exclusion amount per recipient. So the couple together can give up to $34,000 without incurring any gift tax. Simply put, the U.S. tax system allows you to give a certain amount of property to others each year without those gift tax. But in 2023, the 17,000 is for an individual. For couple, it's 34. They can do what's called gift splitting. So gifts beyond these amounts in a year may be subject. In other words, you'll start to add them up. And when would they kick in? Above 12,920,000. So you have to give a lot of gifts. There are also unlimited exclusion for certain type of gifts. The unlimited exclusion refer to certain type of transfers that are completely exempt from gift tax regardless of the amount. What are those? Payment made directly, notice, directly to a university. If you pay for someone else's tuition expense, let's assume you pay them $15,000. Or you pay them $50,000, which is above the $17,000, it does not really matter. As long as you paid the university directly. As long as you paid it to an educational institution, these payments are not subject to tax. What does that mean? Let's assume you have an annual tuition of $50,000. If someone gave it a grandpa or grandparents, they want to pay their grandson or granddaughter tuition. They have two options. They can give them the $50,000 to the student, and if that happens, what's going to happen is they're going to have to deduct 17, and what's left of this, if my math is right, 33,000 will be, they'll have to add it to their gift tax. So what should they do? They should not give it directly to their grandkids. They should give it directly, the 50,000, to the university. So this is important. The payment must be made directly to the institution, not to the individual for whom the tuition is paid. And this unlimited exclusion apply only to tuition. It doesn't apply to books, supplies, room, or board. Another similar exclusion is when you make payment directly to healthcare providers for medical care. For example, hospitals. If you pay for someone medical expenses directly, notice here directly, to the healthcare provider, these payments are also exempt. Again, let's assume grandparents. They want to pay some sort of an operation. It costs $50,000. They should not give it to their grandchild or granddaughter. They should pay it directly to the hospital. This is the key. This payment must be made directly to the hospital, paying hospital bills, doctor fees, and other medical expenses. More about charitable gift and marital deduction. We have to be very familiar with this. Any money transfer between spouses, any money transfer between husband and wife, that's fine. You don't have to worry about anything. This is a provision that allows unlimited exclusion from gift tax for transfer between spouses. That's important. This means that you can give any amount of property or money to your spouse without having to pay any taxes on it. There are specific conditions that need to be met, especially when the property involves what is called terminable interest. Now, what is this terminable interest? This kicks in, just going to give you a scenario. Let's assume we have one individual that married, and this is their first marriage, and they have 2 kids from the first marriage. Okay, then they got divorced, then they married again, then again they have from this marriage, maybe the new spouse has 2 or 3 kids. Here's what's going to happen. This is the new marriage. This is the old marriage. So here's what's going to happen. Husband and wife. So what's going to happen is this. Let's assume the husband wants to keep asset. He wants to keep asset to his kids from the old marriage. Well, he's married to his current wife now, current spouse. So what's going to happen is this. He's going to let his wife manage the asset under something called terminable interest until she passes away. Then after she passes away, the asset goes into the estate. Okay, why in the estate? So this way it goes back to his kids, because he cannot give it straight to his kids, because if he give it back to his kids, then guess what? There's a tax, because there is no unlimited transfer between parents and kids. The unlimited transfer is between spouses. But what he would do, he would create a terminable interest for his spouse, so she can use it, she can use the asset until she dies, then it goes into the estate. So let's talk about this. A terminable interest in property generally means that the interest will end upon certain event, like the death of a recipient. Normally, property with terminable interest does not qualify for marital deduction, normally. But here's what's going to happen. There's an exception for a type of property known as QTIP. For property to qualify as the QTIP, what is the QTIP? Qualified Terminable Interest Property. Qualified Terminable Interest Property. It's like basically you set up a trust. For a property to qualify and be eligible for the marital deduction, having a terminable interest, it must meet the following criteria. Because here's the assumption. The assumption is this. Once you give a gift to someone, they can do anything with it. That's the assumption, right? Here, what you're doing is you're telling your wife, your spouse, as long as you are alive, you can do anything with it. But once you die, it goes into my estate. Why? Because I want to pass some of it to kids. I'm just giving you an example, kids from the old marriage. It could be for other reasons. I'm just giving you the example so you understand the need for this QTIP. So, what are the criteria? So you gave the gift to the new spouse. Okay? Income to the donee spouse. The spouse receiving the property must be entitled to all income generated by the property during their lifetime. So the spouse is entitled to all the income. So if you gave the wife stocks, she get all the dividend. Bonds, she get all the interest. Real property, she collect the rental. No one can share it with her. 2, exclusive benefit to donee spouse. No one other than the spouse can receive any income or principal from the property during their lifetime. They can't. The donee spouse must have the right to require that the property be productive. She control or he control the spouse, the surviving spouse. They control the property that generates the income. Upon the death of the surviving spouse, the property must be contributed to any estate taxes due. Also, the property must contribute its fair share to any estate taxes due. They must also do that. But the reason they do that is to do what? Is to have something left for the kids or for someone after the death of the spouse. So to summarize real quick, the marital deduction allows spouses to transfer property to each other without incurring gift tax, including property that might be otherwise problematic due to its terminable nature. However, to take advantage of this terminable interest property, the property must meet specific conditions that ensure the receiving spouse benefit fully from it during its lifetime. This helps ensure what? That the marital deduction is used in the spirit it was intended, between spouses, supporting the financial unity and security of married couple. Let's take a look at an example real quick. We have Alex and Jamie got engaged in March 1st, year 1. In May of year 1, Alex gave Jamie a watch valued at $30,000 as an engagement gift. Not bad at all. After the wedding in October, Alex transferred $100,000 in cash to Jamie for them to have a joint savings account. Well, both of them are U.S. citizens. Determine the amount of Alex's year 1 marital deduction. Here we go. So, Alex gave Jamie a gift of $30,000 before they were married. Would that qualify for the marital deduction? No. So if he gave her a gift for $30,000, what Alex would do, Alex has the right to deduct $17,000. Remember, there is an exclusion of $17,000, and what's left is $13,000. Therefore, Alex will have to make a note of this, that they have to add to their cumulative gift tax $13,000. How about when they open a bank account of $100,000? Do they have to do anything about this? No, because this is between husband and wife. So the transfer of $100,000 after the wedding qualify for unlimited marital deduction. This is because the transfer between spouse are not subject to the gift tax. However, the $30,000 given before the marriage does not qualify. But how much of it? Only $13,000 of it is potentially subject to gift tax. Again, $13,000, and this $13,000 will have to keep on giving gifts to others until they reach $12,920,000. Remember that magical number? Anything below this amount, gifts or estate, you don't have to worry about it. So only the $100,000 cash transfer qualify for the marital deduction, while the pre-marriage gift would be partly covered by the annual gift exclusion. Let's take a look at this multiple choice questions from farhatlectures.com. In the context of gift tax exclusion, which scenario would not require the filing of a gift tax return? So 3 scenarios would require, 1 would not, and we're looking at the one that would not. Given a friend $30,000 to help with mortgage payment. That's very nice of you. That's fine. Nevertheless, $30,000 is subject to the gift tax. Obviously not the whole thing. You get $30,000 minus the exclusion amount happens to be $17,000, and the remainder $13,000 will be subject to potential gift tax. So A is not. Paying $30,000 directly to a medical facility for a relative's surgery. Would you have to pay to file a gift tax for this? And the answer is no. Why not? Because you paid $30,000 to the medical facility directly. There's an exclusion for that. So B looks like a good answer, but let's look at C. Donating $30,000 to a cousin's personal travel fund. Well, that's really nice of you, but donating $30,000 to the travel fund would not help. That's subject to a gift tax. That's out. Transferring $30,000 directly to a friend to pay his tuition. I think that tuition is excluded. Yes, tuition is excluded if you pay the university, the educational institution, directly. So what should this individual do? Transfer the money directly to the university. They would not have to file a tax return. Otherwise, if they transfer it to the friend and the friend paid the tuition, I'm sorry, you have to. This is a gift. So as we suspected, B is the correct answer. Transferring the money directly to the medical facility, you would not have to. It's an exclusion. Again, if you pay also the university directly, it will be excluded. What should you do now? You want to go to Farhat Lectures and look at additional multiple choice questions that's going to help you do what? Prepare better for the CPA exam, your accounting courses, enrolled agent exam, whatever professional certification you are studying for. Study hard, invest in yourself, and of course, stay safe.